Now moving ahead, as the topic of the training is a bit comprehensive and we have a very limited time, without further delay, I'd like to hand over the floor to our delegates, having a lot of experience and expertise in the field of transfer pricing, Mr. Prasann Kumar Moiti and Mr. Puskar Gupta, to move this training session ahead on the first session of the day, that is the fundamentals of transfer pricing.
Very good morning. Thank you, Mr. President, and thanks to all of you for joining this session. I know on a Friday, it's basically quite a heavy thing before you, but we'll try to make it easy to the extent possible. As an introduction, I am Prasann Kumar Moiti, a partner with PwC India. And I've been doing this for the last 22 years, meaning I joined PwC and doing transfer pricing all through these many years. And of course, with small stint over UK and in Australia. I also look into our Bangladesh transfer pricing practice and also some clients in Sri Lanka as well. So great to be here, and I can see a fantastic arrangement and excellent crowd here. So the objective is to go and delve into the chapters where we have the directive in Nepal, and we now know what is there. The code is there, 70-page, quite extensive. So how we unravel each and every of those sections and rules, and we try to see also that what is happening elsewhere, how other tax authorities are looking into this and how they have been able to evolve, right? Now, I'm using this word evolve because it's not something which is very easy to adopt and implement. So every authority across any country, if you see, they have evolved over the years and have now reached a certain point. But I think it is important that how we in Nepal take this forward, and I think it's a joint collaboration because both the taxpayer and the tax authority has to look at this in a joint manner so that the effective interpretation, the ideal intention of the code and the actual outcome, whether that is in sync with what was actually intended, is very important. So anyway, I think the short point is we will look at each of these aspects, but I would be happy to get questions. So please feel free to stop me and ask questions as we move. Now, what we have here is that, but before going to the concept of transfer pricing, I was just watching this where you have a presentation ceremony, right, for the annual report award distribution. Now, I just got one small, beautiful thing from that is that what are the main requisites for an annual report? To my knowledge, my limited knowledge is that, the extent of governance, the extent of transparency, the extent of substance. I think these are I would say, the parameters where someone is looking into any of the annual reports. And that's exactly where the stakeholders, the shareholders, etc., whoever are relying on that annual report is looking forward to. Similarly, in transfer pricing also, if you look at OECD, and one thing is that you will hear a lot of jargons from us. Sorry for that. But please feel free to stop us and ask, and we'll try to make it simple. So OECD is, as you know, Organization for Cooperation and Development is an apex body of fiscal affairs, tax policy, and mostly all countries follow their guidelines. Now, they also have similar principles on defining how the transfer pricing governance would be, as we mentioned, substance, transparency, and governance. So this is the basic thing, and it's good to see that everything follows from these basic aspects. So in terms of the definition, basically, I think this is something everyone knows by now. People have been reading now for quite some time that what is transfer pricing. So I'll not go into details. It's basically where you have intercompany transactions, you have intercompany dealings. It can be, important thing to note here, the transactions can be recorded in the books. It may not be recorded in the books. So that is one important aspect, and that we call it as arrangements. So whether it is a transaction or it is an arrangement, both actually comes under the purview of transfer pricing. So that's something which is important. And what we are trying to do is that the price at which you are transacting, whether that price is correct or not. So that's effectively, we are looking at. Okay, now why we need to have this law in a country? Can we achieve the same outcome without this law, right? So many countries now have this as a law, but can we say that, I have my income tax act, right? I have my income tax regulations, rules, directives in place. Why then I need to have a separate law on transfer pricing? So the reason is very simple. And I'll take you through the evolution of transfer pricing in other countries in like US, Australia and all. But effectively what I've seen is that even if you have provisions to guard your income in a particular country, there are still avenues by which someone can manipulate that income, right? So this is an example where, we'll try to show you that how you cannot actually catch or how you cannot stop this manipulation by normal means, meaning normal income tax rules or regulations. And hence you need to have some law regarding transfer pricing in a country to prevent the abuse, right? So let us go into an example here. So we have a company, let's say in country A, say US or UK, and then country B, which is in another lower tax country. We have, and the 17% you can get an idea, it's Singapore basically. So we have one in US and one in Singapore, and the Singapore company is buying the product from the US company and selling to the local customer. The import price from US is $1,600, right? And we have not kept account, on customs duty. Let's forget about the other local taxes, right? So here what we see here, the cost of manufacturing this is $1,200 in US, and the sale is at 1,400. So profit we are making is 200, right? And in Singapore, it is sold at 1,600, and these are the additional costs. Of course, 1,400 is my import price, because and that is the transfer price between US and Singapore. Now, if you see the total profit in country A, it is 200, and in country B, it is 100. It's a simple, and this is the tax which I am paying overall. Now, if you see the scenario B, where, let's say if someone wants to manipulate and save the group tax or global tax, what he will do? He will basically reduce the price of export, which is the transfer price. So here you see that 1,400 becomes 1,300, and the profit reduces. Similarly, on the import country, let's say Singapore, we have this, or let's say Nepal only, we have increased tax of 100, profit of 100, right? Because that profit shifts here. Now, overall, what we see here is that savings of around, I think, 13 of tax. So by removing 100 of profit from US to Nepal, I can save a tax of $13, right? So this is basically, now if you ask me that, okay, what law is there to prevent this? Generally in countries, you will not see any income tax rules or law to prevent this unless and until you invoke provisions of GAR and all, which most unlikely to be introduced here. So that's the reason, in order to prevent this, because the country under question here, I think the biggest country, would be the stake, because this country would be happy because they're in that way tax is increasing, right? So it's not a matter of concern for the country B. But country A would be very sensitive to this, because they will have a concern that they are losing the tax, the due right to tax something which is under threat in A. So that is where the country needs to have a transfer. So by invoking a transfer pricing provision, what you are able to do is, you are able to tell the taxpayer that, hold on, you cannot price the good at from 1400 to 1300. Why? No, because 1400 or whatever profit you are having at 200 is the arm's length profit, and they then bring the concept of arm's length. We'll go into details. So this is where the concept is coming, that by preventing the pricing, I am trying to bring a law which is restricting me to change the pricing of these goods according to my whims and fancies. So this is where the challenge is. And just on a lighter note, all global tax consultants actually used to do this only. But again, now this is something which, after the transfer pricing laws have come into place in almost all the countries, this is something which is a past. So now you cannot do this. And of course, with the more evolution of the BEPS and other laws, you are not able to further do anything. So gone are the days of transfer pricing or tax structuring, planning and all. But I would say it's not gone in that way, but what the new age consultants say, that we have also evolved, and now the work is that within the four corners of the law, whatever you can do, whatever planning you can achieve and structuring is you can achieve, is something which everyone is doing right now. So moving on, I think this is exactly this thing. Now, this is one thing which I have learned. Initially, I was not I would say it was difficult for me, not being a student of economics, to understand this concept, because mostly for a chartered accountant, you read a bit of demand, supply and all that in our college and all, but generally you will not learn this. So this is very important, and I'll tell you, the whole sessions which we have pivots around this only, that the relationship between function, asset and risk and the profitability. Now this is I would say the fundamental principle between everything we will talk about in the next 5 hours. Now, what is it? Now, generally this concept, right? Higher risk, higher rewards, and it works other way around. Right? Now, this means that as my activity increases, meaning the intensity of my activity increases, the consequential risk also increases, because I am getting into higher risk taking activities, and hence the risk will increase. My profit expectation would also increase. Now, what it means here, in one way I can also explain, is that an entrepreneur, and I'm sure we know entrepreneur as in who takes the full risk, who takes all decisions, who are in charge of the business, that is an entrepreneur, right? Now, we also have heard concepts, and I'm sure you have heard concepts like contract manufacturing, like toll manufacturing, right? Like job working. Now, these are a bit different from an entrepreneur, because it is restrictive in terms of the functions, in terms of the risk. Because in this curve, if you see the curve which goes from left to right, upwards, the entrepreneurs are supposed to be on the top side of the curve, right? Because their function, asset and risk are highest, and accordingly the profit expectation is also highest, right? So that is where you will see them. But as we move down, you will see contract manufacturers somewhere in the middle, because they are taking less functions, they are less risk. Because, for example, when the contract manufacturer does something for the principal, he does not have to worry about the quality, because the quality is decided and given by the principal, that okay, these are the specifications, I need this material, I need these specs, you need to just follow that. So that way his functions and risk are limited. So this is an important exercise which we do in all cases in a transfer pricing. So this is an important update which happened around about 2012, and you can look up this in YouTube, and public domain. A lot of top companies got questioned by UK HMRC. Like you'll see this, the CEO, global CEO of Google, the global CEO of Amazon, the global CEO of Starbucks were actually questioned by Margaret Hodge, the UK Member of Parliament from House of Commons. And she was actually asking very, very interesting question on transfer pricing. I mean, just imagine a Member of Parliament in UK asking questions on transfer pricing to the global CEOs of some of the top companies. Now, this video will take you through what are the questions and why UK HMRC have to go into that extent. What was the background? And suddenly why it was again coming in public domain, because most of this you will see that these are closed door, right? You don't get to see in the public domain.
Sales in the UK totaling £3.1 billion, an effective tax rate of less than 0.01%.
Am I audible? Sky News Live with City Joel has the latest business update from the Gherkin, as well as you can see a moustache. Hi, Joel.
Things are getting hairy, not least for the executives of Google, of Amazon and of Starbucks. You're not putting enough tax into our economy. That's what's riling us. So says the chair of the Public Accounts Committee. She's basically accused all three companies of avoiding their tax responsibilities here in the UK. It's an accusation all three deny. As you can see there, that's the public policy head of Amazon appearing before MPs there. Starbucks, the world's biggest coffee chain, was first up. It has paid only £8.6 million in corporation tax over the last 15 years of sales in the UK, totaling £3.1 billion, an effective tax rate of less than 0.01%. The company says it's only because it's failed to make a profit over the last 15 years. An explanation that didn't seem to go down very well.
15 years, Mr. Alsted. You've given the UK business 15 years. You're still making losses, and yet you're carrying on. If it's true.
Yes, I assure you it is true. It's very unfortunate. We're not at all pleased about our financial performance here. It is fundamentally true, everything we're saying and everything we've said historically.
It just doesn't ring true. Either the two are inconsistent. You've run the business for 15 years and you're losing, and you're carrying on investing here. It just doesn't ring true.
Well, Amazon have also been given a pretty hard time by MPs. The company's been asked to explain why a CD or a book bought in pounds sterling on...
Okay, before we go to the Amazon, if you just note the statement. You are making losses for the last 14 years. Is there a law to catch, or I mean, how can I question it? Is there a law to question losses in a country? You are not paying taxes, right, because you are making losses. Legally, they can't question Starbucks. That was Starbucks. Now, that's the reason why they mentioned that out of 14 years or 15 years, right, it was only 1 year they came on profits on which they paid taxes. So, interestingly is that this is one cue where the takeaway is that, if you are having losses, you need to be very careful on what is leading to that. And given that you have intercompany transactions, because a lot of those products like raw material, coffee, etc., comes from Brazil or any other intercompany, their own company and not third parties, this question is a grave transfer pricing question, because the question can come that, okay, are you importing at a higher price than market price, and that leads to the loss. Now, tax authorities are now gearing up basically to get their hands on how to ask these questions in a legitimate way.
A UK company, of course, is registered in Luxembourg.
We're running a single European business.
It comes with a UK. I believe I'm dealing with a UK company. It comes to me via the Royal Mail with a UK stamp on it. That's what happens. And I tell you again, so far, I might change my mind, I've been purchasing regularly from you in that way. When did any book that I ever purchased ever get to Luxembourg?
So we do not have
Have you got books in Luxembourg?
No, we do not have a fulfillment centre in Luxembourg. We have our European headquarters in Luxembourg, and as a single...
But the books are here?
The books could be in the UK, they could be in France. If you're purchasing English books, it's very likely that they will be in our fulfillment centres in the UK.
Thank you. Well, I do...
Just so you're clear, by the way, a fulfillment centre is a warehouse in Amazon speak. Now, Germany says that Greece has made considerable progress in approving austerity budget.
So, I think the takeaway there is, they have fulfillment centers in UK, but they have, some of the main warehouses outside UK, and they ship those products into UK. The people who are taking decisions as to pricing, taking decisions as to the shipments, taking decisions on inventory levels, taking decisions on how much discounts to give, are all residing in UK. Whereas, because of their unique invoice mechanism, they are not able to book profits in UK, which they are actually doing in Luxembourg. So, that was the issue which came up. Again, a transfer pricing issue. Well, this is again, one example where because of some of these which were happening, later on OECD framed the action point on BEPS, base erosion and transfer pricing, base erosion and profit shifting, which is of course not only transfer pricing, but it has to do with international tax and global trade. So, let us just look at one.
Well, we did ask Google for an interview, but no one was available. Earlier, I spoke to the chair of the Public Account. Well, we did ask Google for an interview, but no one was available. Earlier, I spoke to the chair of the Public Accounts Committee, Margaret Hodge, and I asked her how a company that is not breaking the law can be evil, devious, and unethical.
First of all, it's not clear to me that they are acting within the law. This is an issue of judgment, and really it is down to our tax authorities to demonstrate that they are carrying out business in Britain.
But there's no question mark in HMRC's mind, is it? I mean, they clearly think that you don't really understand the law, because their chief executive said this is expert tax knowledge, and I'm afraid that's something I think we do rather better than a select committee.
Well, let me just say this. The HMRC refused to discuss with us Google's tax affairs because they hide behind taxpayer confidentiality. So I don't really know what judgment they're making. I don't know what they're thinking.
Well, if they did what you wanted to do and moved their business onshore to Britain instead of Ireland, why do you think there would be much more tax paid here, given they don't pay much tax in Ireland?
Well, they don't. They have such a complex company structure that you're quite right to say that they immediately export all their profits from Ireland.
So we wouldn't benefit, would we?
I don't know what the Irish do in arguing that with Google. I would again expect our tax authorities to be vigorous in defending the UK taxpayers' interest to make sure, again, that minimum amount of profit is lost in the argument on transfer pricing, so that it's a legitimate transfer pricing, not an illegitimate transfer pricing.
Okay, so this is again.
Well, we did ask Google for an interview.
Sorry. So this is again, an example where, the customer base is in UK, right? The whole customer base in terms of whether it is their ad services, I mean Google's ad service, or their whole platform service, cloud service, the whole customer base is in UK, whereas the billing is happening from Ireland. So, the profits are getting booked in Ireland, and you have a whole bunch of marketing people sitting in UK, and you only remunerate based on either a cost plus or a commission basis, and hence not much of profits are getting booked in UK, and hence not much of tax which is coming. So, that was the angst. I am not saying right, wrong and this, but the key thing to note here is tax authority are now very vigilant on something which is affecting their base, their tax base. So, that is something which is the key, and lot of I would say actions have been taken up because they feel that globally, because of transfer pricing, around 3 to 4 billion of tax bases are getting eroded, and that is something which is as per the OECD report. And now we can talk about, in here you can see, how lot of countries have looked at transfer pricing in a more focused lens. So, what is the significance? Well, this is very broad, but just to give an insight on this, that one is it gives you a arm's length pricing, which is a fair basis, market basis, principal to principal basis of pricing. That is number one. And then we have also which takes care of the compliances for both the countries. So, here I think very important, let us say when I am doing transfer pricing for Nepal, I need to also look at the transfer pricing of my other country. So, if I am interacting with say UK, Australia or Singapore, because it is always a two-side story, right, because my pricing, whatever pricing I am going to decide for import is going to also affect the pricing in the other country. So, that is the reason we say that transfer pricing is not only the it's not only one country aspect or concern, it's basically both the countries. So, yeah, a little bit of knowledge of the other countries transfer pricing regulations also helps. Well, this is something which we will take in greater details as to how the profit allocation happens. Now, the simple point is that every country is fighting to maximize the profit of that country so that he can tax it, right. So, let us say a company who has got operations in 5 countries, right, and it makes 100 of profit, total profit. Now, in these 5 countries, whether country 1, country 2, 3, 4, 5, right, it's someone will say that no, my country gives the maximum contribution to generate profit, I should tax 100%. The other country will say that no, it is my, because your IP is based in my country, your whole intellectual drive is happening from my country, hence I should have the maximum right to tax. So, this is a fight, actually it happens, we have seen practical examples, we will take you some of the case studies, where actually countries are fighting, tax authorities between themselves to look at how far I can tax, or to what extent. Now, how as transfer pricing experts or transfer pricing consultants we deal with that. So, we have something called profit split method, we will talk about that method. This method comes into our rescue as to how the profit allocation should be done in a scientific manner. And of course, this is quite huge because it has a direct impact on the reputation, and more companies are coming into the foray as to okay, what should be today if I am being out in the media for transfer pricing, it is a big point, and we saw some of those examples, right. So that is where we have in terms of the significant, let us see how it evolved over the years. Well, this is again example of early, I think in US it was in 1928, right, long back, and that was the first country which enacted something like some regulations on transfer pricing to prevent tax erosion. OECD came together in 1963, then 1979, ultimately in 2002 and now we have in 2018, which is the OECD transfer pricing guideline. And you can actually Google it, it's quite a big, and when we started work, I mean in my initial days, it was only a 100-page document, and now it is almost a 1400-page document. So, it has evolved, a lot of things came into that. You can log into oecd.org and you can access this document, which is this is known as a globally, this is a Bible for all transfer pricing, consultants and experts. So, this is not only followed by the consultant, but a lot of tax authority have also imbibed those. So, whenever India brought in the law, more or less they followed the transfer pricing, and I think for that matter any country when the law they follow the OECD transfer pricing guidelines. And then we had the BPS, which is again a work of in 2013, where OECD actually saw that lot of taxes are getting escaping rather in the bracket in terms of collections because of transfer pricing, and they brought in this BEPS.
The 2008 financial crisis and successive tax scandals acted like a wake-up call. Globalization had brought many benefits to the world, but people and governments realized that it had also facilitated tax evasion and avoidance, resulting in a strong sense of unfairness. Bank secrecy and lack of transparency helped high net worth individuals hide their assets offshore. Loopholes in the international tax rules also allowed multinationals to artificially, yet legally, shift their profits to low or no tax jurisdictions. Governments had to take action. International cooperation was vital to introduce some form of tax regulation to globalization. Through the G20 and OECD, countries worked together to build robust international standards, organize tax cooperation, and to restore trust in the tax system, leading to one of the great success stories in inclusive multilateralism.
People were concerned about the loss of revenue, particularly during a financial crisis, and yet the loss of revenue from tax avoidance and tax evasion was taking money away from the exchequers and the finance ministries. The most controversial issue at the G20 was this issue of tax. We had to compromise, and the compromise was that the G20 would ask the OECD to take action, and that began the 10 years of work on greater transparency.
The Global Forum on Transparency
We are quite sure that tax inspectors without borders will be able to help our revenue authority to be more efficient in managing our tax system and to reform it appropriately to ensure a greater level of revenue to support our development.
So, interestingly, while this was going on during 2012-13 till 2015, when they came up with the 15 action plan, there is something which was also parallelly, which was in the cook, was in exchange of information. Now, exchange of information is such a handle with the tax authority, where if let us say there is a company in Nepal and they have whether a headquarter or a subsidiary in Australia. Now, in order to get information on the Australian company, the tax authority of Nepal will not ask the taxpayer in Nepal. They can directly go to the tax authority of Australia, the ATO, Australian Tax Office, and ask for the information. So, because there is something called exchange of information through the treaty mechanism, nowadays, and that exactly was, she was mentioning about borderless tax authority. So basically, as we see, borders are kind of diffusing, and exchange of information. In fact, without the consent, that is a different part, whether it's a legal or but yes, I think it is very much which is happening now, and it's kind of a new normal that my information, my profits, information on my company, information on my taxes can be accessed by the tax authority through this exchange of information route. So that's quite interesting, and it's actually, we are seeing in a lot of cases, the tax authorities are taking this measure.
To the progress to date on international cooperation.
At a time when the global economy is already suffering enormously due to COVID-19.
The OECD and its bodies have demonstrated a unique ability to bring countries across the globe together to solve some of the most complex challenges of our time. As the COVID-19 pandemic continues its course, governments have had to fundamentally rethink tax policy and administration. We have provided immediate responses to countries to tackle the effects of the coronavirus, developed new standards for the effective collection of cross-border tax, expanded our internationally comparable tax revenue data, and continued to support governments on the path to decarbonisation. Going forward, we must pursue this inclusive journey towards greater tax regulation of globalisation, take action towards a greener recovery, and work together to provide long-term certainty to our tax systems by reaching an international agreement on digital.
So, with that, I think, the basic objective was to say that what kind of focus international community, OECD, the tax reform committee, they have something called a committee for fiscal affairs headed by, at that time, Saint Paul's Passau, French person, and he had actually instrumented a lot of reforms and action points. So, one of that, as I think you can see in the first heading, where the amount of loss, revenue, the revenue means tax revenue, is huge, as you can see, 100 to 240 billion. This is a OECD data globally. And around 4 to 10% of the global corporate income tax revenue is again, this relates to that kind of loss. So, they had to work together to bring in some method to the madness, and then came all these 15 major action plans. Now, digital tax as the first one, which is again, a big issue, because now no longer the situs of asset is becoming a prominent thing, because in digital world, you don't need an asset to be placed in a particular country. So, you can have a server somewhere else, the programs, platforms can be in the cloud, where the customer is sitting in Nepal, let us say, and the revenue is generated from Nepal. But the tax authority of Nepal may actually wonder and see that, okay, the companies may not booking profits because the invoicing is happening outside. People, in terms of marketing, in terms of generating sales, they are outside. and hence how do I tax anything which is in Nepal? And okay, the other thing is important that from the existing profit attribution rules of P and all, there also I do not have a direct nexus with the generation of sales or profits. So, then how do I tax this customer? I get the revenue in customer, my whole user base is in Nepal, let us say, and there are huge, so for example, if you look at any digital, the big players, right, the Google, of the world, or also in the world of this social, the Netflixes of the world. Now, there the user base is in a country, the revenue is actually generated from that user base, but it goes somewhere else because the revenue collection is happening somewhere else where the subscribers are all getting logged, meaning the logging happens, the logging device is somewhere else. So, how do I manage this whole, and the tax authorities are actually grappling with, but to that a big I would say rescue is on BEPS Action Plan 1, which is on digital economy, and we will touch upon that in our coming sessions. Well, I think we spoke about this. Okay. So, what is this pillar 1 and pillar 2? Okay, right. Now, this pillar 1 is a basic framework where mostly digital companies will be getting, I would say not tax, will be basically will be ambit of under this pillar 1, and there is a specific tax which they have to pay in the country of source of income, and of course, we have to see in the country of the situs of the assets also. So, there is a framework which is given, and this is applicable to mostly the bigger players having a specific consolidated revenue. The pillar 2 again, it's basically again the next tier where they are talking of global minimum tax. So, they are saying that 15% of tax would be applicable irrespective of that country, whether it is a tax free country or not, or tax haven. So, for example, today you have heard of this British Virgin Islands, Bahamas. Some year back it was UAE, Dubai, but now Dubai has a corporate tax 7%. So, we will not talk about Dubai, but other countries where you do not have to pay any tax. As per the current pillar 2 framework, you have to pay a minimum of 15% tax. So, whether that country has a tax or not, you are still required to pay a 15% tax, and that tax would be collected from the ultimate owner of the business, meaning ultimate holding company. Right. So, there are a lot of detailed laws which have been enacted now, and in terms of how to implement this, and overall lot of countries, more than I think 20-25 countries have also adopted this in their local jurisdiction, in their local laws. Some of the neighboring countries, if I see how they have been developing. So, for example, I can talk about India. In 2002 when the law came in, transfer pricing law, of course, it was more of learning. 2002 to 2005 it was more of learning for both the sides, and we had a great time because no litigation, no real great things happening across. But as we proceed, as we move around 2007, we saw things flaring up, and that is where we saw that the learning curve actually happened on the revenue authorities side. So, whenever we used to go and interact with them, they were quite smart enough to pick up, and they actually learned a lot. So, that's an interesting thing which happened, and example of this. So, this is an interesting data. I just wanted to, I think I have some time now, right. So, I will just take you through this quickly. This is anyway in public domain. There was a publication from the government of India. It says white paper on black money. Now, this is the data which came in 2013. This publication was issued. Now, what we see here is that each of the financial years across the country, the number of cases which was which was picked up for scrutiny. What is the data, what is the adjustment and how much is the adjustment happened? Now, this is something which, a kind of madness in 2010 and 2011, that time I remember in my earlier days. So, out of 10 clients, what we found, 7 clients got their adjustments. So, the notices, everyone got notice, and the way tax authority looked at that, everyone is a defaulter. So, it's like, if you have transfer pricing, if you have intercompany transaction, that means there are some issues, and I am going to look at in a very detailed manner. So, that happened in those years. But again, having said this, how much of this led to the actual realization of the taxes is a separate question, and we will come to that. But the adjustment was made. Basically, tax authorities were successful in issuing notices that, okay, this is the amount of tax, amount of income which has not been subject to tax in the country. So, this is where I think this data is relevant. Now, some of the interesting aspects I can show you, at least in the Indian context. What happened is, when we have a law like transfer pricing, which is a subjective, it is because I am saying subjective because this arm's length word, and we will see when we look at how to implement the law, there we will see that when we look at things like whether it is within the arm's length range, then how to construct the arm's length range, which is from point A to point B, how to construct point A and how to construct point B. Now, these are a lot of subjectivity which comes, it's basically when we say subjectivity means a combination of science and art, right, not purely an art, because after all everything has to be backed by logic and pure common sense, that is all, right, nothing, no rocket science, but it has to be logical, it has to be based on common sense. So, now when this was happening, the taxpayers went to the next forum, which is the commissioner appeal. Commissioner appeal again was just passing it on to the next level, which is the tribunal. So, ultimately all the adjustment which you saw in the previous slide landed before the tribunal, and that is where if you see the number of rulings which we have, I mean till now there are 7,000 plus rulings from the tribunal on transfer pricing, and this is the way it all happened in each of the years, right. So, we can understand that the kind of litigation which is there, and each and every, of course, what happens in a litigation is that you spend time, you spend efforts, keep apart the consultant's fee, but the time and the effort which goes behind each of these for a minimum of 7, 8, 10 years is quite concerning. Now, we have tried to also look at that which are the areas in which the litigation happened, right. Now, if you see, the biggest area was IT and ITES, whether it is back office, accounting, we normally have a lot of those entities, the service sector in India, right. So, they represent IT companies, ITES companies. So, that is where the biggest of the transactions and the rulings we saw. And of course, then we have manufacturing, and we actually we have the subsequent sessions where Pushkar and my team will be getting into within manufacturing what are those transactions which was scrutinized, right, whether it is a payment of royalty, license fee. Then we have trading distribution, and I think this is very relevant for an economy like Nepal, which is the inbound, we understand, and maybe I may be wrong, but mostly have distribution entities in Nepal, and of course, automobile and pharma, and the other thing of course we basically is the banking sector, which is also some subject to a lot of transfer pricing. So, with that I think more or less I am done, and we look forward to the coming sessions where I think we will go into much deeper on each of these aspects, but For the timing, any questions, I'll be happy to answer. Right. No, so we have this, right? We have in the slide, I think we will detail it. We have exactly on this, what are the definition in the Nepal law, what are the definitions in outside, and we have that part. So I think it will be good.
Member of OECD and was not part of the G20 inclusive framework. But we wanted to show you that because we wanted to show that how things are evolving and how things are fast evolving in the world of transfer pricing and international tax. And it's not that just because the transfer pricing law has come in recently in Nepal that it will take time to also implement those best practices in Nepal also. Because yeah, maybe in India it took almost 10-12 years to do that because Indian transfer pricing started a long time back. But for Nepal it will be much earlier, what I believe. And I think that's why when you see the directives, they have already mentioned about the APA, though the procedures and the rules may not have come, but it was a very welcome move for the APA. And I think you also have started with the digital service tax in Nepal as well. So that clearly says, even though Nepal is not a signatory, like other countries like India, France and all, Nepal is also following this digital services tax. So those was just shown or mentioned just to ensure that just a holistic picture what's happening in the world of transfer pricing and international tax.